Let's take a look at this week's data. Only an idiot tries to time the market, says our two famous old-time investment fellows. I'm going with Bender's advice. Here's a look at a super long-term timer. We don't use this for our normal timing. I just use this to show off that our formula actually can cover a very long time period. Here's from 1993 up till today. And here's the actual zigs and zags. Whenever the volatility jumps up over a certain limit, we're out of the market. When it comes back down, we go back in the market. If it's out for a long time, we're out for a long time. We were out clear down to here before we got back in, which was a very good plan because that was a pretty rocky road down there. There's the 2008 crash. We were pretty much safe on that. Almost got all of that, a little of a clip on that. But this weird slow drive down here and then come back, we avoided that. So it's a very good long-term formula based on the average 2 range percent on the QQQ. Now here's all you need to know about the stock market. Almost nobody can match the S&P, which is the same thing here, SPY. Almost 99.9% of all the advice in the world will sell you enough things that you'll have some SPY and some bond. And they get you around 60-40. Whether they tell you you got 60-40 or not doesn't matter. You're going to end up in this range. They'll get fancy names on it. They'll call them targets. They'll call them retirement by the age, blah, blah, or they won't. But sooner or later, you follow the advice, you'll end up with a portfolio that doesn't look a whole lot different than this spot right here, which isn't any better than having cash, which is 0, and holding some S&P. That's a straight line down from 0 up to S&P. So if I was king, I would make a rule you couldn't talk unless you could beat this line. And you had to prove it. If it didn't work, you can't pretend it works. You can't show an example and say, look at this great idea I have. Unless you could time it. Here's at least, before 2006, so that you get the effects of the 2008 crash in your system and show, well, what will you do? And the best thing to do on risk and rewards, the easy part of this, your percentage average gain per year. Everybody can figure that out and they know what's good and what's bad. What's difficult is the risk. There's all kinds of fancy equations you can use. You can say standard deviation. But in reality, in working with people, they are just as apt to jump up and down about the maximum drawdown. And that's easier to figure out. It's easier to see. That's what your gut reaction is when you look at your portfolio and you say, I'm down 20%. How come nobody told me? Well, this actually works quite well to make a universe and put a dot for everybody's clever idea and compare it to what you're going to get from the typical advisor or just jumping between cash and the S&P. So here's different things like a 200-day moving average, an 85-day moving average. They're quite a bit less risk than what you're going to hold here, and you make almost the same money as the S&P, and you make more money than all this wonderful advice. Well, I have better equations that go back a long time. My two very best, I use the QQQ and I have the ATR percent. I also have one that uses the 200-day moving average the percentage of the stocks, because that will bounce up and down between 100 and 0, and use that as a long-term timer. This sort of a risk of about 12%, 13% in a return over 18%, that's just simply unheard of. A crash is now starting. Avoid the rush out the small, narrow door. If you want to find out how crowded that door is going to be, procrastinate. You procrastinate, you're going to see the prices tumble at a much faster rate. We've replaced the everything is awesome with a crying baby. I'm crying with you. There goes a great run at the market. We don't know how long this crash is going to be. Is it going to be as bad as 2008? Who knows? You don't have to predict that. All you have to know is get out now. And if it turns out we're a little early and nothing happens and we come back in, we really haven't lost that much. Anybody that knows the real math of it, you can be out of the market almost all the time and still make more money than any of these advisors will tell you with their buy and hold. I'm mostly cash. I have a little bit of gold, a little bit of junior gold miners. Disclaimer: this presentation is for educational purposes and is not financial advice. Investing is risky. Our timer from 2006 still says buy, but we're selling right now, and I'll get into why. We go down here. We have had 15 trades. None of them have lost money, but now we're down to only 58%, and we were up about 65, 66, something like that. So it's dropped from what it was. And it's time to collect all of our cash and sit tight. The VIX is starting to jump and it continues to get worse. Now we're up almost 19. 20's a red line that almost always, anytime it gets up over 20, you're almost guaranteed trouble. And it looks like we're close enough to it now. It's not unusual to get out when you've had such a fast run up that there's going to be continued difficulties here, and we need to be out now. Our portfolio too was a mixture of both long and short the volatility. That's still okay, but the way gold has taken off lately, I think it's actually going to make more money and might even be a little bit safer to simply sit back and be mostly cash with a little bit of gold. And if you have a little bit of gambling inclination, a few percent of the gold miners, the junior gold miners in particular, to see what happens here with gold. With the 401ks out there, it's time to go cash, most of you. Those that have the ability to have a commodity index like COMIX, you're okay. In fact, you ought to be 100% COMX now. Sell the POEX and buy more 100% COMEX. If you've got VIGAX, sell it. If you've got this, sell it. OIEJX, it's okay for now. Let's take a look why. QQQ, sell and go cash. All of these go cash. This is off Morningstar. COMEX is the commodity. It's doing just fine. It's way up here now. Almost all of them have tanked along with QQQ, except this one right here. This is our OIEJX, and it is a mixture of stocks and income fund. And so because it has kind of started to turn up here, right here, it looks like the income producing part of the fund, they've made some adjustments. It might be just fine. So even though it's not making any money, I'm going to say, yeah, hang on to that a while. See if that income portion of the fund continues to improve, and you won't have to sell that just yet. But be ready. It could turn down pretty quick. We talked about this last week, the history of gold breakouts. Gold gets going once in a while and really goes crazy. It's an interesting ride. It can crash pretty fast once the ride's over. And so it's always one of those interesting things is deciding when to jump out of a runaway train here. Well, it's already had this big jump up, but I think there's a very good chance gold can really take off from where we are now. So I'm in there a little bit. So here you've got QQQ and the S&P, and they're down almost 7% drop on QQQ. At the same time, gold is up 6.35, and the gold miners are up a little over 7.5%. So I'm getting a little mixture of both of them while I go cash on everything else. Timing signals are actually still 100% buy, but in both instances, I'm going to tell you why I'm ready to go cash right now anyway. The volatility as measured by the average true range percent still says buy. 200-day moving average percent above for the NASDAQ 100 still buy. But we are going cash because of the strength of the deterioration we're looking at. Here we see our QQQ, that's the 100 stocks in the NASDAQ, the percent of them over their 200-day moving average. That has deteriorated. It's picking up steam. It's very close to triggering. It's clearly on a hard downward trend. The S&P 500, you look at these 500 stocks, the percentage of them over their 200-day moving average, it's now in the same downward trend. The Russell 1000, it has already had a sell, and it continues to have that same bad slope going down. So there's no bluebirds across the entire market here. Everything is headed down. And there's a lot of momentum behind this measurement. When this really starts to drop like it has, it's generally going to continue for some time. And now you see the actual QQQ. Yeah, we've fallen down here 7%. So this does not look good. Does not look like there's a bluebird that's going to pop this right up anytime soon. So if we zoom in a little bit on the 200%, there's the 80% line, the 70% line. The trigger here is at 57, and we are coming down. We're already 62. A few more days, it's going to hit the trigger. What's likely to hit the trigger Monday is our volatility measurement down here. You see this red line coming up so fast. When it crosses the trigger red, it's a sell, an absolute sell across all of our portfolios. So the 200-day moving average percent is falling fast. Volatility is on a very sharp rise. Either or both will trigger in a day or so. Only an economic miracle can save this crash. Time to go cash right now. Any questions, give me a holler, send me an email. Thanks, and we'll see you next week.